what are we currently learning from the AI bubble? So here's what we are currently learning from the so-called AI bubble. Massive investments and valuations. Global spending on AI is at unprecedented levels, expected to reach $375 billion in 2025 and $500 billion by 2026. Over 1,300 AI startups are valued over $100 million, and nearly 500 are considered to be unicorns, which are, valued at over $1 billion, drawing strong parallels to the dot-com boom of the late 1990s. So also investment outpaces real returns. Despite enormous investments, studies show that the vast majority of AI business initiatives have yet to yield real returns. For example, a recent MIT study found that 95% of organizations surveyed saw zero ROI, despite collectively spending up to $40 billion on generative AI. Circular and complex financing. Major deals between companies such as NVIDIA, OpenAI, and AMD resemble the complex circular financing arrangements of past bubbles. And analysts warn that these vendor-friendly financing structures, often not tied to actual earnings, echo signs of past speculative markets. Transformation and speculation coexist. While experts agree that AI is genuinely transforming some sectors and has real long-term potential, near-term speculation and high expectations are fueling inflated valuations for startups, many of which lack viable business models or profitability. Energy and infrastructure impact. Stock valuations for industries associated with AI infrastructure, especially energy providers and semiconductor companies, have soared, sometimes far outpacing these companies' actual earnings. The rush to build data centers and secure computational resources is now straining power grids and prompting debates about sustainable growth. Enterprise hesitation. Though customer adoption has been extremely rapid, for example, ChatGPT reaching 100 million users faster than any prior app, enterprise adoption is more cautious. Concerns about privacy, reliability, and financial risk linger, slowing down widespread integration. Classic. And so, what are the signs? And some of the differences that we could learn from here, right? So, analysts see familiar warnings, right? Overhyped investments, detached valuations, and financial engineering. However, key differences include higher current profitability among the largest tech players, and that some funds are being spent on tangible, lasting infrastructure. Still, the risk remains that oversupply and speculative bets could leave behind stranded assets such as unused data centers if expected demand fails to materialize. And so, in summary, we are learning that while the AI boom may contain bubble elements categorized by hype, immense investments, and speculative excess, it is also underpinned by real technological advances. The challenge is to distinguish lasting opportunities from speculative exuberance and to be mindful that not every AI bet will pay off, even as the underlying field continues to shape the future. And so we're going to our first, let's start here. The AI bubble. Is the AI bubble about to burst? So recent expert analysis suggests that fears about the AI bubble bursting are increasing, but there's still quite a bit of debate about how close we are to that actually happening. Warning signs emerge. Some investors and economists are sounding alarms about excessive valuations and inflated expectations, especially as many AI startups remain unprofitable. For example, about 54% of investors now believe AI related assets are already in bubble territory, and 95% of surveyed AI projects reportedly haven't turned a profit. Historical, and so here are the historical parallels that raise fears. The situation is drawing comparison to previous bubbles like the dot-com crash of 2000. Experts warn that when bubbles burst, the collapse can be catastrophic, not only for those in AI, but for the broader economy, given the massive capital inflows involved, right? And so the possible burst in late 2025, which doesn't seem possible since we are currently in November, right? But anyway, some predictions, such as those from technology analysts such as Ed Zitron, expect the AI bubble to burst as soon as Q4 2025. Like I had mentioned, doesn't seem as likely. But many analysts caution that it's notoriously hard to forecast exactly when a bubble will pop. And so, three scenarios are actually mentioned, and this is by a recent Forbes analyst lays out three possible outcomes, right? The bubble continues with more investments and hype. It bursts, causing widespread financial loss. You know, some project up to $40 trillion in NASDAQ, or it deflates gradually, with some companies surviving while others fail. Watch for worsening debt loads and failure to achieve profitability in major firms as key indicators of an impending burst. And so, however, not everyone agrees, right? Some leading market analysts argue that, unlike previous bubbles, some of the investments in AI infrastructure are likely to yield sustainable returns. If Even if short-term exuberance cools and many companies don't survive. And so what does this all mean, basically in summary? There is mounting concern that the AI bubble could burst soon, potentially later in 2025, which again doesn't seem likely. It's November. Driven by debt crises, persistent lack of profitability, and unsustainable hype. However, it's unclear if or when a full-scale collapse will happen, as some see lasting value in current infrastructure and innovation. The consensus is to remain alert for classic bubble signs, but there's still considerable uncertainty as to whether the worst case scenarios will actually be realized. And so, what can business owners observe about the bubble, right? Business owners can essentially observe several key trends, risks, and lessons from the current bubble, right? Such as elevated valuations and hype. Many, as I had mentioned earlier, many AI companies are being valued far above their current profits, driven by speculative investments and intense hype. This high concentration of capital poses risks if expectations aren't met, which could drive abrupt market corrections. There's also rapid capital allocation, right? Enterprises and tech giants are directly unprecedented amounts of operating cash flow into, or wait, enterprises and, okay, rapid capital allocation. Rapid capital allocation. Enterprises and tech giants are directing unprecedented amounts of operating cash flow into AI initiatives. often diverting resources away from other business lines. Data centers and infrastructure are a major area of investment, sometimes accounting for more than 1% of national GDP growth. And there's also ROI that is under scrutiny, right? The majority of AI pilots and early business deployments are not yet delivering measurable returns. Business leaders are increasingly shifting their focus from broad experimentation to targeted projects with real operational fit and proven business cases. There's also concentrated risk, right? Most recent market gains are due to a small cluster of AI related tech stocks, creating significant risk in portfolios and business models that are heavily exposed to these trends. Business owners should be aware of the potential for volatile market swings. There's also market correction hazards. If a bubble bursts or corrects, eh, okay, so there's also market correction hazards. If a market bursts or corrects, there could be reduced demand for AI products and services, slower product development, loss of strategic partners, and potential write-downs from unrealized investments in infrastructure or talent. There's also technology disruption and oversaturation. Rapid technological change means that huge infrastructure investments like data centers could become obsolete quickly if new inventions, for example, advanced chip designs or quantum computing, emerge. Oversaturation also means that not every AI startup or project will survive, and only the ones with clear value and operational focus will thrive. There's also regulatory risks. Increased scrutiny from global regulators is introducing more compliance requirements, legal risks, and exposure to reputational damage or litigation, especially if AI deployments fail to deliver as promised or cause unintended harms. There's also pragmatic adoption wins. Companies that succeed tend to be pragmatic, focusing AI initiatives on high impact core business areas, investing in data governance, and continuously reskilling their workforce. They avoid chasing hype and instead build for durable incremental value, learning from the survivors of previous tech bubbles like eBay and Netflix. And so for business owners, the key is to maintain discipline, avoid speculative bets, and build resilience into operations, ensuring your business can adapt both to rapid change and to possible market corrections. Stay grounded in fundamentals, focus on operational fit, and prepare for a future in which not every AI investment will yield immediate or lasting returns. So innovation surge, but also volatility. The market sees a flood of new AI models. Example, OpenAI's GPT-5, Google Gemini, Claude, Claude's Sonnets, and Claude's models essentially. Meta's Llama 3, and generative tools and consumer enterprise applications. Users and businesses benefit from powerful new capabilities, such as automation, creativity, problem solving, yet may also face rapid obsolescence of previous tools, confusion from too many choices, and uncertain long-term support. This pace creates winner takes most scenarios, but also increases the risk of releasing half-baked products or features that fail to deliver real value. And so essentially, well, what does all of this mean? You know, the opportunity. The speed of product launches means AI adoption can leapfrog, allowing businesses and individuals to solve problems previously thought impossible. Yet there's also a warning, right? This velocity can undermine stability and customer trust, leaving some users and enterprises struggling to keep up or adapt. And so basically, the fast innovation isn't just risky, it's an engine for learning by doing, for market feedback, and for finding the true edge of what's possible. And so where does this show itself, right? OpenAI OpenAI, Google, and Meta each released multiple major model upgrades in 2025 this year, sometimes just months apart, drastically reducing the time between generations. You know, Microsoft's Copilot suite integrated new features at a monthly cadence for Office, Teams, and Azure, challenging competitors to keep pace. Startups are launching new applications in areas like legal AI, healthcare, and creative design at a weekly rate. You know, investor analyst reports show that 2025 saw more product launches in AI than the previous 3 years combined. And so, what does, again, in summary, rapid product development is transforming industries and users' lives, but also brings volatility, confusion, and a need for careful adoption. Companies who can balance speed with quality using market feedback to refine their offerings are best positioned to benefit both now and in the long run. And so you probably know a lot of people adopting AI to their businesses, right? And yes, AI adoption is spreading rapidly across service-based businesses, brick and mortar, and small businesses, far beyond just tech companies and Fortune 500 giants. You know, with mainstream AI adoption across all business types, from restaurants and retail to hospitality and local services, small and mid-sized businesses are integrating AI tools into their daily operations. This grassroots adoption is driving the real world test for whether AI delivers tangible value. Measurable performance gains and evidence of real ROI for, when deployed strategically, AI is delivering concrete results, improved customer satisfaction, cost reductions, higher sales, and operational efficiency. This validates that AI has genuine utility beyond hype. And so, what does all of this mean? The positives: widespread adoption across traditional low-tech sectors signals that AI is becoming a practical, accessible tool, not just a speculative asset class. And so it also brings a counterweight to bubble concerns, because if AI is delivering real value to restaurants, retailers, and small businesses, then some of the investment is justified, even if other parts of the sector remain overheated, right? And so the fact that small businesses with limited budgets are adopting AI suggests that the technology is becoming democratized and affordable, moving from speculative hype to useful utility. Which also takes us here, you know, we've seen large corporations start to adapt AI. You know, the adoption of AI by large corporations, of course, is another critical condition shaping the current AI landscape and bubble dynamics, right? Healthcare, retail, manufacturing, and tech are integrating AI into their core operations at an accelerating rate. This adoption ranges from automating routine tasks to deploying generative AI for product development, customer service, and data analysis. Uh, And so, what does all of this result to, right? The transformation and hesitation. Many corporations are seeing improved productivity, cost savings, and enhanced offerings through AI-powered automation and analytics. However, the adoption journey is often cautious. Large enterprises face hurdles such as integration challenges, data privacy, and regulatory compliance, risk of costly failed projects, and the need for workforce reskilling. And so, what does all of this mean? I mean, there's a positive. The positives are widespread corporate adoption, demonstrates that AI isn't just hype again, it is genuinely improving global business operations and creating new value streams. However, there is a caution. The hurdles and caution among enterprises serve as a reality check, slowing down the bubble's most extreme impulses and forcing more grounded, risk managed innovation. And so basically, what seems like slow or cautious adoption may actually be wisdom in action. Only the most robust, trustworthy AI will ultimately integrate at scale, and this discipline strengthens the ecosystem. And so basically, like what large corporations, like the examples of large corporations are, Bank of America, Goldman Sachs, Walmart. Pfizer, Unilever, and you know, have all made 2025 headlines for their large scale AI deployments, ranging from automated customer support to supply chain optimization to drug discovery acceleration. Companies such as Microsoft, Google, and Salesforce now offer AI enabled platforms as default options for enterprise clients, driving sector wide experimentation. And there was also a 2025 MIT survey which showed that over 60% of Fortune 500 companies have released at least one production AI system, though 70% also cited ongoing concerns about ROI and compliance. There's also there was also a report by Accenture and McKinsey that enterprise demand for AI talent and responsible AI governance is up 40% year over year, reflecting both enthusiasm and the need for careful management. And so, in summary, large corporation adoption of AI anchors the technology in real world value, validating its potential while enforcing a more rigorous and risk aware pace. The big players' moves signal both mainstream acceptance and a maturing market, one that's likely to reward companies who combine ambition with thoughtful execution. And so, which leads us to the next thing, which is we've seen these companies get billions of dollars in investments, right? Of course, you know, which basically is just a reinforcement of what I said, in which these billions are flowing into both AI startups and major corporations, driving the pace and scale of the AI revolution. In this current climate, right, there are massive capital inflows, venture capitalists, institutional investors, and even governments are pouring unprecedented sums into AI companies. The largest tech firms like Microsoft, Google, Meta, Amazon, and Nvidia, and leading AI startups have secured multi-billion dollar funding rounds, strategic partnerships, and infrastructure investments in 2025. And so, which has resulted in the following: growth, acceleration, and investment risk. These huge investments enable rapid product development, cutting edge research, and deployment of new data centers, chips, and AI platforms. However, this abundance of funding also inflates company valuations, encourages risky bets, and can contribute to bubble like conditions. Not all investments pay off. Some startups burn through their capital without achieving profitability, while others become acquisition targets or consolidate to survive. And so, essentially, what does all of this mean? The opportunity. Capital enables innovation at scale and empowers companies to pursue breakthroughs that wouldn't be possible otherwise. The warning: excess investment can breed inefficiency, waste, or overconfidence, making financial discipline and proven business cases ever more important. And so rather than seeing high valuations only as signs of a dangerous bubble, they can also represent confidence in the transformative potential of AI, funding the infrastructure and experimentation that powers the next wave of progress. And so how is, again, these are just, real life cases, right? Microsoft invested $10 billion in OpenAI, and Google committed $2 billion to Anthropic in 2025, aiming to secure leadership in generative AI models and infrastructure. Nvidia's market cap surged past 2 trillion, even though now it's touched 5 trillion, Um, it fueled, and that was again fueled by investments in chips for AI workloads and data center expansion. Venture capital investments in AI startups topped $120 billion globally in 2025, with hundreds of startups closing rounds above $100 million each. Multiple reports in Forbes, CNBC, and in Investopedia confirm this funding surge, coining phrases like the AI gold rush and linking it to today's bubble risks. And so, in summary, billions in investments fuel the AI ecosystem's rapid growth, but also brings risks and volatility. Companies benefit from the resources to innovate investors found while investors and founders vigilant to must remain vigilant to ensure those funds build lasting real world value. Disciplined investment strategies and robust business plans are essential to survive and thrive long after the bubble subsides. And, of course, there were also rumors of inflated, and of course, I mean, there were also rumors of inflated revenues and etc. Now, let's get to the right now. So, what is happening as of right now, right? At the midst of the chaos, what do we understand for sure? Majority of people don't know exactly what they're doing when it comes to AI. We understand the goal that is to be achieved by AI, understand the value which is to be utilized and the potential it has. However, yes, AI has a lot of potential, yet people don't seem to fully understand how or what to do to unlock it. Probably because it is simpler to sell these AI solutions being released into the market rather than figure out a way to have the AI create your desired outcomes a lot more consistently. And by the way, this is the bubble. Big tech companies releasing products and the market, for example, on YouTube, selling in behalf of the company, selling features rather than solutions. And so the time that would have to be spent learning these AI solutions is not only time consuming, the efforts and sacrifice that it takes to do this is a lot. It's easier being an affiliate, like a lot of these YouTubers. However, even though the AI adoption has certainly increased during this AI bubble, thanks to these affiliate, for example, the AI automation agency and service providers, not to knock them down, however, many of them fail to achieve the desired results that AI is capable of producing. Yes, AI is, of course, very capable of automating operations. However, it fails majority of the time to make an effective impact on the bottom line. The AI models cannot solve every business problem as of yet, at least not on their own. This is because majority, if not all, the AI models are trained on generic public data, meaning that it's more suitable probably for research and getting general solutions to, general conditions. People trust it because of the dangerous assumption that AI is the solution rather than the tool that can help you realize a solution in a much shorter time. And like any tool, there must be capabilities that you must unlock in order to take full advantage of this golden opportunity and being able to just use the tool as effectively as you can. To be able to unlock this capability, you must change and adapt quickly and make your firm or agency focused on the cornered resource that makes AI work effectively, the 20% that makes 80% of the difference. This is embracing and understanding the importance of data in the AI. Data is literally the backbone that makes AI operate and deliver results, not just efficiently, but also, most importantly, effectively. So, what needs to happen is you need to turn your firm into a data driven organization. And not only just your firm, you as the founder or employee needs to be more data driven. And this is done by creating the correct data environments that allows your AI to effectively learn and integrate within the organizational environments and help create solutions that are critical to your organization's unique situations. Have it fulfill solutions at the same quality a lot more consistently. So if there is one word that business owners should obsess over, is data.